Hello, this is Brian Shannon from Alpha Trends Blogspot. Today is Sunday, September 10th, 2006. I've got the MDY on the screen right now. This is the mid-cap spider. We usually look at the Russell 2000, which is the IWM. I wanted to bring up the MDY, though, because it's given me a little bit of reason for concern about this market. These are the mid-cap stocks, and they do, what they do is represent what the typical mid-cap stock does. Now, the IWM, we've been drawing a similar trend line, such as this one. However, that IWM has been holding and closing above that level. You can see here that the mid caps have closed back below it last week, and they weren't really able to get much bounce at all. During the course of the week, compared to the Qs or the SPY. And that tells me that it's time to be a little bit concerned here. We've also got this trend line right here. So we're at a very important juncture, I think, for the mid caps. Breaking below and closing below 134, I think, is going to be potentially big trouble for the mid cap stocks. Now, we've seen on the IWM that the trend line that's similar to this has not been broken. However, these mid caps have been broken, and that trend line has been acting as resistance on diminishing volume on the way up. This gives me more reason for concern than anything else in the market out there. This is the MDY. Let's take a look at the IWM just to compare the two, because when we see this similar trend line, you can see that the IWM is in better shape. Now, the mid cap, the MDY, mid cap stocks led this market higher for years, and this could be a case where we have to really stay on our toes, and this is why stock selection is going to continue to be very important through the rest of the year. And it's just, let's just not underestimate the power of good stock picks, because that's what it's all about, that and managing risk. It doesn't matter what the market environment is, there's always a way to go wrong, and there's always a place to make money if you're in the right ideas, and that's my job, is to hopefully bring those ideas to you and help you understand the logic behind them. So these mid caps, MDY, are giving me reason for concern. Another reason for potential concern is Google. Now, Google has been bulletproof this whole market environment, last few years since they came public. You can see it's been holding on this longer term uptrend line, and as it holds above this trend line, the volume is diminishing, and we've also got all these moving averages that have crisscrossed it lower. And now we've actually got, when we drill in on this, you can see the red is below the blue, which is below the green. That means the 50-day moving average is below the 100-day moving average. The 100 is below the 200, and they're all declining. So the longer term trend, represented by the 200-day moving average, or 40 weeks here, is down in Google. Now, when we look at a daily time frame, let's get a little bit of more clarity by just changing the scaling. We've got these lower highs, and we've got this little trend line in here. Now, I'm concerned that if Google breaks down, that might be what it takes the market with it. We could see Google, I think, pretty easily back down to test 360. If 360 were unable to hold, well, then I think that these lows from earlier in the year near 330 would become a target. And although it's not a huge percentage move, 40 points lower here in Google, that's only about, what, 8% or so. I think it would really hurt the psychology of the market overall, and that could hurt the market itself. So, with that said, those are my main concerns about the market right now. Let's go ahead and take a look at some stock ideas, and remember that we are in a high-risk environment, but there's still potential to make money. Bebe Stores, symbol BEBE. This stock broke past some resistance, and that resistance has been acting as support. So that's a weekly time frame. When we look at the daily time frame, we can see a nice low volume pull back to the rising 20-day moving average. Now, in this stock, what we want to do is we want to buy it, I think, above $21.45. You could put your stop right about 21.18 is where you would want to put your stop 21.18. So that'd be about, what, 27 cents away. And I think we're going to see at least a test of 22.70, these recent highs. So a little more than $1.30 of upside for the potential risk of maybe, about 30 cents. So I think that's a nice risk reward play on Bebe Stores. Chaparral, whatever you want to call it, this steel company, CHAP is the symbol. It broke out last week to new highs on heavy volume. It's consolidated those on light volume. Let's take a look at the weekly time frame. You can see nice volume, nice breakout, good volume. So when we look at a shorter term time frame, here's what we see, and that is the stock needs to get above some resistance that it's had just in the short term at 38.25. Above 38.25, I think you could buy this stock and set your stop about 37.78. So we'd have about 47 cents of risk. And on the upside, I think you're going to see the stock make a run for about $40 a share. So that would give us the potential opportunity of about $1.75, risking 47 cents makes, again, for a nice risk reward once again. Enzon Pharmaceuticals, symbol ENZN. This stock here on the weekly time frame looks like it's been tracing out a nice longer term accumulation pattern, and the volume's picked up somewhat in here. It's finding support above this rising 10-day moving average, the 10s above the 20, the 20s above the 50, etc. So when we look at this, the stock has pulled back nicely on Friday right in here. I think right now you just want to see confirmation that the buyers are aggressive. Buy it above 821. I think you could put your stop below this low right here. This low is 814, so you could risk about 8 cents. And on the upside, I think ENZN is due for a move past this this little resistance level in here. You can call this a shoulder, a head, and a shoulder as well. But I think the stock could make it up towards $8.75, $9 a share on ENZN. Let's see. That's all I'm going to give you right now for longs. I've got just two shorts I want to look at. Our good friend Celgene, CELG. Looks like it's time to look at this guy again on the short side. And looking at a weekly time frame, the stock has had a phenomenal run. Now it looks like it's really consolidating. I think you could see a shakeout down towards 38 bucks a share in the next few weeks. That's not going to be our initial target for this swing trade. Instead, we'll look for this 200-day moving average to be tested down about 39.5. And it keeps coming down and testing this level where it's found support at about 40.5. The more time support is tested, the less demand there becomes at that level. As the buyers just get sick of buying it there, they say, hey, there's too many sellers, I'm going to walk away. And we've got lower highs leading to that. So I think we're going to see a break. And right now the stock's in a good low risk position for a short sale. So if we look at CELG, you can see where it closed at $41.28 on Friday. What I'd like to see it do is rally up to about $41.45. So if we can get up to $41.45 only, so don't want to sell it short. If it gaps down, you'll want to sell it short if it makes it only up to $41.30. But if it gets up to $41.45, I think you can sell the stock short then as it drops back down through this low right here, this low being $41.30. So we want to see it trade at $41.45 first, then sell short as it gets a little bit of downward momentum, taking out $41.30 on the downside. And I think at that point we would be looking for a move down to 39.5. So that would give us a target of $1.80, and I think your risk could go right above this 5-day moving average at $41.85. So your risk is about 55 cents, and we're looking for about $1.80 of risk. So that makes for a real nice risk-reward ratio in Celgene. And if it makes a sharp move lower, let me just go back to Celgene again, because this stock seems to have a habit of having these sharp, sudden breaks. If it does that, by all means, cover part of your position into such weakness, especially if it gets down near that rising 200-day moving average, near that target. And that would go for any of these stocks that rapidly break down to their target levels. C.H. Robinson, CHRW is the symbol here. This stock, it looks like it's tracing out a multi-month high up in here, multi-month peak rather. And I think that the sellers are really starting to be of concern here for the longs, and it looks like it just keeps testing this support level. Now the stock is making these lower highs and lower lows. We've got this declining 5-day moving average, and I think we want to look for a little bit of strength in here in this stock. It closed at 43.20. I think that if we can get it up towards about 43.60 and then break, then short it as it breaks down below maybe 43, not that low, but if it gets up as high as 43.60, let's sell the stock short on a 25-cent break. So if it breaks down to 21.35, that's where we would sell it short. We would put our stop above this high, 43.75 or so. So there wouldn't be a whole lot of risk. But on the downside, I think that you could see a quick breakdown through this support level and probably down towards about $42 a share or so on CHRW. Now, I've got a few other stocks here I'm going to mention briefly. I have a class coming up on Friday. That's a 3-hour class. I know a lot of you took a look at the preview for that class last Friday. And in this class, I'm going to teach you how really what I call trend alignment works. Now, the stocks that I typically mention on this blog are liquid stocks that trade a lot of volume. I don't want to mention stocks that trade less than 400,000 shares a day, and even that might be an aggressive cutoff. However, there are a lot of stocks, especially now it seems, that are more thinly traded than that are setting up very nicely. Let me show you a couple of those. One is ALTH. This stock, broke out here. It only trades 136,000 shares a day, but look at that big volume breakout. Right there, it traded 940,000 shares. Something's going on. Low volume on the consolidation, and it's got a real nice looking longer term chart as well. So a lot of these stocks that I'm going to mention here, ANST, same thing. Here it's a thinly traded stock. It's pulled back down, 380,000 shares. It pulled back down on the 10-minute time frame. Looks like it had a shakeout. Now it's probably ready to go again. And CLEC, C-L-E-C. This stock had a breakout, pulled back. Now it's consolidating in here above this prior level of resistance. And looks like the longer term, it could really get going in here. I've got just dozens and dozens of these stocks, and I'm not going to mention them as a habit. What I'm going to do, though, for anyone that signs up for this class on Friday, and you can do that through the links or go over just directly to marketwise.com. For anyone that signs up for that class, what I'm going to do for the next 3 months is I'm going to email you a list of those. Just a list. I'm not going to tell you entry instructions or exits. I'm going to leave that up to you. But each day, I'm going to send you a list of the stocks that are lower volume, and I'm only going to do that for people who take the class on Friday. So there's a little bit of incentive for you to sign up for that class. That's how I get paid for doing this blog, by the way. You might be wondering why I do this for free. Well, here's my way of monetizing it. I have no bones about hiding that. So go ahead and sign up for that class, or you can call Dennis Remke at 1-877-MKTWISE to sign up for the class. Thanks for your time, and hope to see you guys in class on Friday.